Okay, so this video is going to be about incorporating your Social Security benefits into your retirement plan. I would say if you look at the general population, virtually everybody understands what Social Security retirement income is. A smaller portion of the population maybe understands how it's funded via payroll taxes, and then a very, very small portion of the population understands how your Social Security benefit is actually calculated. And if you know that, it actually can go a long way towards helping you understand how the Social Security benefit can actually be incorporated into your retirement plan and how it impacts, to a large degree, what you have to save. And so what I'm going to do in this video is I'm going to take you through 6 sample couples and some really, really rough financial plans and show you how what their income looked like prior to retirement impacted their ultimate Social Security benefit, and how that also dictated how much they had to save in order to live off of 75% of their pre-retirement income. And the examples actually will show you that it's a lot more drastic than you might think. And when we get done with that, I'm going to show you exactly how your Social Security benefit is calculated. And that will probably help you understand how you get to these places. And it should hopefully also help you understand how to incorporate that into your own financial plan. So what I'm going to do is I'm going to take 6 sample couples, and we're going to start them at 35, and we're going to say they started with nothing. They'll retire at 65 and have a 30-year retirement. I'm going to start with 2 couples making $40,000, 2 making $80,000, and 2 making $240,000. And the reason I'm doing 2 of each is in each scenario, I'm going to have one where we have a breadwinner and a spouse that doesn't work. So in other words, the $40,000 couple, we're going to have a $40,000 and 0 income, and we're going to have 2 $20,000 incomes. And even though your household income is exactly the same, having your income comprised differently impacts your Social Security benefit, and I'll explain that also. So when we look at that, I'm going to start with the $40,000 couple. So if we start with a couple making $40,000 with a single breadwinner that makes all $40,000, what you're going to find out is that in order to do a retirement plan where our probability distribution says that we've got nearly 100% chance of making it through retirement, what we have to do is we have to save about 6.5% of our income in order to meet that goal. If you're a couple that each makes $20,000 a year, that is only going to get you to about an 84% probability of success. And the biggest reason for that is if you look at that couple's Social Security benefit at full retirement age, the couple that had one spouse earning $40,000, the other earning 0, actually has a full retirement age Social Security benefit of a little over $30,000 a year, while the couple that had equal earnings only has a Social Security benefit of about $27,700 and some change. That's an interesting difference, but between the two, what you'll notice is that the first couple is going to replace 76% of their income with Social Security, and the second couple actually only replaces about 69% of their income. Why is that? We'll talk about that a little bit at the end. The second couple here, so we've got a couple that makes $80,000 a year. One of them makes $80,000 and the other one makes 0, and that couple needs to save about 16% of their income in order to have a nearly 100% chance of success of making it through retirement when we look at it from a total probability distribution. Now, when I say probability distribution, what I'm saying is we have to account for variability in savings. Some people might make 7% over time, some might make 10. The order of returns matters. If you watch any of my videos, you'll know how much sequence of returns matters. And so that's what I mean when I say probability distribution. Not everybody's going to have the same pathway towards retirement. If I look at another couple making $80,000 a year, where each spouse makes $40,000 a year, saving 16% is only going to give them a 90% chance of success. So again, a little bit lower chance of success, even though their household income is exactly the same. Now, why is that? Well, the full retirement age benefit for the couple making $80,000, where only one spouse had the earnings, they actually have a little over $49,000 in Social Security benefits at full retirement age, and that equates to about 61% of their pre-retirement income. Whereas the spouses with equal earnings, they only have a benefit of about $40,000 at full retirement age, and that only represents 50% of their pre-retirement earnings. And so that accounts for the fact that you're probably going to have to save more in that scenario, even though your household income was identical. Now, the third couples, the fifth and sixth couples, technically, the third example, I'm going to look at as $240,000 a year. So in the first example, one spouse makes $240,000 and the other makes 0. In order to look at a probability distribution for a couple like that, In order for them to get a nearly 100% chance of success over time, they have to save about 40% of their income. So a huge number. And the biggest reason for that is that they only have $66,000 of Social Security benefits at that income level, which only equates to about 28% of their pre-retirement income. The couple that each make $120,000, they actually only have to save about 35% to have the same probability of success. And the reason for that is that their full retirement age amount for Social Security is about $77,000 a year, which is 32% of their pre-retirement income. So this is one of the quirky examples. We obviously had a pattern going a very specific direction in the first couple of couples, and if you thought we were going to keep going that direction, you maybe were caught by surprise by this one. But the reason for this has to do with how Social Security is taxed. So Social Security is funded via the payroll tax. Payroll tax, if you're employed, is paid partially by you and partially by your employer. And if you're self-employed, it's paid entirely by you. But one of the things not everybody understands is that there's a taxable wage base for Social Security. And the max taxable earnings in 2023 for Social Security are $160,200. That means that once you make over $160,000, you are no longer taxed for Social Security. But what that also means is that you don't get any credit for income, which doesn't increase your Social Security benefit over time. And so what you'll see with this pattern is that at lower income levels, your Social Security, more of it is replaced in retirement, and at higher income levels, less. And typically, what you'll see is a spouse with one breadwinner and one that didn't make any money actually makes a little bit more money in retirement up until you hit that taxable wage base. And then it changes a little bit, because in the last example, one where there was a couple where each made $120,000, they're getting credit for all of their earnings in retirement, whereas the other couple is only getting credit for about 80% of their earnings. So to explain this, I'm going to show you a little bit about how Social Security is calculated, and then based on that, I'm going to show you some data from the Social Security Administration that give you kind of an idea how much of your income Social Security will replace in retirement. So the way that Social Security earnings are calculated in retirement is they'll take your taxable wage base over 35 years and then they'll index those for inflation. That means they'll adjust it so 1990 numbers look like 2023 numbers. So if, for example, you have 45 years of earning, they're going to take your highest 35 and average those out. If you have 20 years of earning, they're going to take your 20 highest years of earning, average those out, and then the other 15 are going to count as zero. So once they get that, they take that annual number, divide it by 12, and that is what's called your average indexed monthly earnings, and that's how they're going to calculate your Social Security benefit. But the way they calculate it is that you get significantly more credit for your first $1,015 of earnings. So the benefit formula looks like this. So they take 90% of the first $1,015. They take 32% of every dollar from 1,015 all the way up to 6721, and everything above 6721 you only get 15% credit for. So you can see that the higher earning you are, the less credit you get for Social Security, and you saw that in the examples, right? The first couple had 76% of their income replaced, and the couple with the lowest income replacement was actually at about 28% at full retirement age. And the Social Security Administration actually has data that support this. So they look at how much of your income is replaced by Social Security by income quintiles. And if you look at their CPI average, which is just an inflation adjusted average, you can see the lowest income quintile replaces 268% of their income. And if you're saying, well, how do you replace more than 100%? Well, the reality is that some people get Social Security benefits in spite of not having any earnings. All right. The second lowest income quintile gets about 77% of their income replaced, then 56, then 46, then 39. And that's the same pattern you saw in my examples. So what is the takeaway from this? Well, the takeaway from this should be relatively simple, and that's that the lower you are in the income spectrum, the more that you can expect Social Security to replace of your pre-retirement income. And that also means that likely in order to have the same lifestyle in retirement, you probably need to save a little less as a percentage of income. And the higher you are in the income spectrum, the more you're going to have to save to maintain your pre-retirement lifestyle. Now, if you're a math sleuth and you looked at the beginning and you said, well, somebody that's saving 40% of their income in that last example isn't going to need to spend 75% of their pre-retirement income in retirement. Well, you're exactly right. But the biggest reason for that is that the more that that your retirement income is dependent on variable sources like stock and bond investments, the more a probability distribution is going to vary over time. So that for that same person, they actually only have to save about 27% of their income to get an 80% chance of success. It's just that over 60-year time periods, returns are highly variable. So I hope the takeaway is pretty obvious here. If you enjoyed this video, if you enjoyed this type of content, like and subscribe to the channel, and then comment on some things that maybe keep you up at night, some things that you have questions about, maybe don't understand. But if you want to take away, like I said, one very specific thing from the video, it's understand how your Social Security benefits are calculated and understand how the way your household's benefits are comprised matters, and use that to your benefit when it comes to building your own financial plan.